Welcome back to the second half of the last part in the multi-time frame analysis and market structure video. This has ended up being quite a long saga ultimately, but this is the main basis of how I trade. So it's really, really important we get this clear. Without this really good understanding of market structure, why the market moves in this way and how to use it in our trading, it's the foundation of the trading. And just like anything, the foundation is wrong, then everything falls down around it. So it's really important to get it right, even if it takes us a little bit longer time. I'm going to try and keep these videos in bite-sized chunks for you, so it's easy for you to absorb the information and come back as and when you're ready. If you haven't done so already, please do subscribe to the YouTube channel, pop that notification bell so you get notified when the next part of the series comes out, and do me a huge favor if you can like my content and comment below with anything that you're struggling with in your own trading, and I'll put together content and videos for you to answer your questions. So Part 3, breaks of structure. Now, we'll do a full section on breaks of structure, but it is really important to understand why they're so significant. Breaks of structure are where price ultimately pushes down in the direction of the trend that we're in, and gives us an indication of where price is likely to go next. So I'm just going to draw in the structure here, as you can see. Now, I sometimes get asked, kind of what quantifies as a structural high or structural low. I don't personally think there's any hard and fast rule around it. You have to use your common sense, really. Some people will say, let's just move this out of the way for now. Some people will say that a structural high is when you get this formation. So a candle that pushes up with a candle to the left of it lower, and the candle to the right of it lower. So if you understand how a candle works, this is the open of the candle. We then had a push down, a push up, and then the close of the candle. Okay, so if we have a candle here, which is higher than the two candles either side of it, or the four candles either side of it, some people will quantify that as a structural high point. Equally, on the other side, if you have a candle that pushes down with one or two candles either side of it that are higher, that's a structural low point. Personally, I don't use any rules like that. Personally, the way I look at it is I just use my common sense. Does it look like a swing high or a swing low? Well, it's very clear to me in this current marketplace what is a swing high and what is a swing low. That's clearly a swing low. That's clearly a swing high. That's clearly a swing low. Do you see what I mean? It's common sense, really. You can see without that line there what are the swing highs and the swing lows. And I think it's not worth overcomplicating it, because there's a million different ways to draw these on, and as long as you get the main structural points correct, you're not really far wrong. Now, the significance of these breaks of structure are, if we think that in every time frame there is a different trend. So whilst we're on a downtrend on this time frame, when we drop down to this time frame, this is an uptrend. When we drop down to this time frame, this is an uptrend. So the counter trend moves in this are, they are on different time frames. They're on lower time frames. And when that happens, ultimately, for this short period of time, so from here to here, okay, we have more buyers in the marketplace than there are sellers. Okay, same here. From here to here, we have more buyers in the marketplace than there are sellers. So it's a constant battle. Remember, this is a zero-sums game. Imagine it like a set of scales. And what's happening in these areas, okay, is there is an imbalance effectively. There's a battle between buyers and sellers. The sellers have been in control all the way down here. The buyers have started to take a little bit of control back, okay, and the sellers have taken control again. So this is why these breaks of structure are significant, because it shows us the breaking point of the marketplace. It shows us what we're effectively seeing here is where the buyers have taken back control. And in trending markets, what often you'll notice as well is that let's say this is we know this is a big downtrend, okay? What we can clearly see here is that in this downtrend, the buyers aren't really in control. What normally happens is there's a sell-off. People then start taking profits, so the buyers win for a little bit, and then when price gets into a better value area, so let's just say that's a range, okay? We've done this before now, so you probably see where I'm going with this. prices got back into a premium area, and so then the sellers get back involved. Okay, and the similar thing happens all the time. You've got another one down here, of course. Okay, and this, you know, kind of just links into everything that we've been discussing so far, is that you've got another one down here. That's our range. Okay, the people have then taken some profits. The buyers have started winning for a little bit, and then when price gets back into premium, then the sellers get back involved and they start selling off where they want to be selling off. So this is the constant battle of the marketplace. The breaks of structure, what they do is they tell us where price is indicated to go next. Okay, they give us a clear indication of where we expect price to go. Now, the amount of money it takes to break these structures is pretty big. As you can see, these moves down, these long candles, that means sellers are significantly outweighing the buyers. And this is why the breaks of structure are so relevant, because it indicates to us where price is going to go, okay, and where it's going to come back to. The breaks of structure are the most important part. Other than structure, market structure in general, the breaks of structure are one of the most important part of your trading, because they tell you where the market is headed, and they tell you where the weight is, whether that's in, you know, the buyer's hands or whether that's in the seller's hands. Well, it's the breaks of structure that tell you where to go. And when we then look down onto lower time frames and we stack multiple breaks of structure on multiple different time frames, it allows us to get into much better trades. So breaks of structure are significant. They are a clear indication of who is in control of the marketplace, because below these lows, there'll be loads of market orders and stop orders and stop placements and things like that. If you think everyone's been buying from here, to take all of these buyers out of the marketplace, there has to be loads of cash, which is normally why you'll see this break and then a further push down. You can see it happens all the time. Here's a perfect example. There was loads of buyers in the marketplace at this point, which is why there's been a reaction there. But ultimately, the sellers have outweighed them and they've shot the market down and left these huge, huge candles. So what's happening here is that the expectation of multiple brains, multiple people in the marketplace is that we are in a premium area, so we're going to sell off. So what happens is that when people see this, they then add in loads and loads of sell orders. Then the sells massively outweigh the buys, and then you get left with these huge impulsive, what's called imbalance candles that again we'll cover. These are again another significant part to our training, these long untested candles, but we'll come back to that in another lesson. The important thing to note is that the breaks of structure indicate to us where market is going. And in order for price to break structure, it takes loads of cash. If there's loads of sellers in the marketplace and we've had a break of structure, what it then tells us is that the likelihood is that this is going to continue selling off. And then we use things like our rangefinder and various other time frames to get us into really good trades. Here, you could have taken this trade really comfortably like this, and you got yourself a really nice 5-to-1 for not doing much else other than drawing on a red line, putting a break of structure line where we know structure is broken, drawing a rangefinder, drawing out a premium area, and then just literally waiting for price to come back into it. Okay, it really is as simple as that. And that leads us on to point 4. So point number 4 is how we can develop a bit of freedom from the charts. Okay, so we're not spending hours. It's really simple. We can draw in our zones. So in our uptrend, we know where our discount zones are. We don't want to be really looking for trades until we're in those areas. So we can draw on our discount zones. We can set alerts and then wait for price to come back into them. Set alerts really, really easy on TradingView. You just hold your cursor where you want the alert to be. You click the little add symbol and click add alert. And as you can see, then it adds an alert in. So well, let's say price was up here and it was moving up. We know, and it starts to kind of move back down, break structure lower on the lower time frame. We then just set an alert and wait for price to come into there, and then we can walk away from the charts. One of the biggest reasons people fail at trading is that they overtrade. They're constantly waiting, and they say they're buying from here, and then they're buying from here, and then they're buying from here, and ultimately what happens there is they lose over and over again, get really frustrated, and then they miss the bigger move. That's because people generally want to be trading all the time and taking positions all the time. Well, actually, we know that we don't really want to be buying until we get into the discount area. That's where the value is, and that's where the big players are going to be trading from. So we want to be trading alongside them. We want to be trading with the strong money, and the strong money isn't in the marketplace until we've reached this discount area, and then we've rejected it and started pushing away. So if we set an alert here, okay, we can then be signaled when price comes back into the zone and ultimately take our trades when we know it's a much higher probability trade. Okay, so we've spoken through the first 4 points. So one, to show you where price is most likely to reverse from. Well, we use our market structure swing highs and swing lows to indicate to us where we're most likely to get reversals from, using our range finder and finding our premium and our discount zones. Point two was to prevent you from entering low probability or average trades. Well, we know now that we want to be buying from premium, buying from discount and selling from premium, and we don't want to be really buying or selling in that middle section there. Okay, we've touched on breaks of structure and how we can use breaks of structure to get better entries and indicate to us where we're going to be trading from. And then point four was freedom from the chart, so not spending hours and hours and hours upon the charts, marking out our premium and our discount zones depending on whether we're in an uptrend or a downtrend, and then setting alerts on these zones, and then we can come back to the charts when we're in those areas. So 5 was my secret recipe to ensure that you always get the best trades with the highest probability, that they have the best winning potential, and you know how we go about doing that. So really simply, it's just about putting it all together. Okay, multiple time frame analysis is so important. Okay, this uptrend here, okay, we can clearly see high to low, low to high. Okay, let's just mark that out. You can clearly see that this market is breaking structure to the buy side. Okay, so we now know whatever we were doing before doesn't really matter. We are now in an uptrend. Okay, so if we want to be buying this market, really simply, okay, we just need to draw our range finder on, okay, from our high to our low, okay, draw out our discount area, okay, and now we've got a tradable zone. Okay, so we wait for price to come back into this zone by setting an alert, and then we drop down on a lower time frame. Now I'm just going to track this chart back, okay, just so we don't lose all the price action. Okay, I'm going to track this chart back. Let's drop down to something like the 15-minute time frame. Okay, so what we can now do, okay, is wait for price to enter our zone, okay, and then wait for a break of structure. So by break of structure, okay, we can now start looking at these areas, okay, for buys. Okay, price has broken structure to the upside, okay, and we are now in a buy bias, okay, because we've entered our area and we've now started breaking structural points. Okay, this is another structural point that price broke. Okay, let's just track this back a little bit more. Okay, we now know that this marketplace is a buy bias. Okay, so we've entered our zone, we've started breaking structure to the upside, and we can now start looking for buys. And the same thing again, now on the 15-minute time frame. Okay, let's see if we get something on an even lower time frame. So again, let's track this market back just to here. Okay, so we don't lose the price action. Let's see if we can get down to a 5-minute. Okay, so on the 5-minute chart, okay, we know we've hit our discount area, and we know we're now looking for buys, okay, because this is where price is most likely to reverse from. We've had our breaks of structure on the 15-minute, and now on the 5-minute, we're going to see if we get some breaks of structure to get into even better trades, okay, and we get one exactly here. Okay, so this is my secret recipe, okay, using usually 3 time frames to tell us when we should be trading. Now this is going to get a little bit confusing on the chart, so just bear with me. Okay, we've had this big move down, okay, break a structure here, break a structure there, okay, and a return before a push up. Okay, I'm going to color this green so it's nice and clear. Okay, but this now is our lower time. So we've had higher time frame, which is the 4-hour, I think it was. We've had the medium time frame, which is the blue line, which was our 15-minute, and now we've had our lower time frame, which is the 5-minute. Okay, so break a structure here to the upside. Okay, second break a structure there to the upside. Okay, there to the upside as well, which we already kind of know. Okay, that second break of structure there. And what I'm going to do, just for simplicity for the time being, I'm just going to hide these 2 lines. Okay, let's just hide them away, lock them, and we'll hide them. Okay, this is the trading view, such a powerful tool, really helps with our trading massively. Okay, so we've had these breaks of structure now on the 5-minute. We know we're looking for buys. Okay, we've had these breaks of structures. Okay, and as we discussed in previous, we can now trade from these areas because we know that price is most likely to move from these areas. So if we draw in our range here, okay, we draw a range from our high to our low, we draw on our discount area here, okay, we know now we've hit higher time frame discount, so we're looking for buys. In our medium time frame, which is the 15-minute, we started breaking structure to the upside, so that's telling us that buys are even more likely. And now we've got the 5-minute time frame breaking structure to the upside as well. So what this tells us is we've got 3 time frames. So my secret to making sure that my trades are always the very, very best is stacking 3 time frames in your favor. So if we're looking for buys on a higher time frame, I want the medium time frame, so something like the 15-minute, breaking structures to the upside from a discount area. I then want a lower time frame, 5-minute or the 3-minute, for example, breaking structures to the upside from a discount area. And then we've got 3 time frames all doing the same thing. The probability then of these trades winning is much, much higher. And it's as simple as that. This trade, if you expand it out, okay, let's say you held it here. Let's just play out what happened. I'll tell you what we'll do first. Okay, let's get our, where's our object tree? Let's get our lines back in so we can see everything, okay? There's one. Okay, so we can just use this one for the time being, okay, because we know price goes up there, okay? If we held this trade here, we'd have a lovely kind of 6R, okay? Where's the next one? If we held this trade, let's just zoom out to say the 30-minute, just bear with me. Okay, to the next structural point, which was here. Okay, so our trade now becomes a 12-to-1, and this is why this works so well, because we've stacked these 3 time frames together. We've got buy bias on all 3 of them now, but we can use the higher time frame to set our targets, which gives us much better trades. Okay, if you just used the higher time frame for your entry, you would have got a half decent trade. Okay, you'd have entered there. When we reach discount, your stop would have had to be below that low because, you know, it's relevant to the time frame that you're on, remember. Okay, if you're on a higher time frame and you're trading a higher time frame, your stops have to be for the higher time frame as well. So that discount area, that low is there. Price could come all the way down to the bottom of that if it needs to. So we have to use the time frame that we're on. Okay, but this one here, for example, you heard it, you'd have got 3R. Okay, if you'd taken the trade from the 15-minute range, which was this to here, you'd have entered about there. Your stop would have been below the low, which was there, and you got a 5-to-1. Okay, not bad at all. However, using the 5-minute time frame, when we get that third time frame linked up together, okay, that is now I think it was a 12-to-1 or something like that. Okay, so this is how we can use 3 different time frames, stacking them together to get the best possible trades. And once they're all in line with each other, okay, the secret is to get 3 time frames in line with each other, and then your trade not only has a much higher likely outcome, okay, because things happen on the lower time frames quicker. Okay, so the breaks of structure on the higher time frame, we don't get a new break of structure until we move all the way up here. Okay, till price comes all the way up here. Okay, so that's our new breaker structure. So for us to know that we're going higher even further, we have to wait, you know, hours if not days. Well, on the 15-minute chart it happens a lot quicker. So this breaker structure on the 15-minute chart, well, great, we get into that a lot sooner. The breaker structure on the 5-minute chart, again, we get in a lot sooner. So it allows us to get into the trade sooner. Okay, but most importantly, that the odds are stacked in your favor. You know that by having 3 time frames synced up together, with all 3 time frames in a discount area, okay, because the premium and discount is relevant again to the time frame that you're on. Premium and discount on the higher time frame is different to premium discount on the lower time frame, of course, because the trends are different and the ranges are different. But once we've got all 3 of those stacked up together, we change our trades from being a potentially 2-to-1 up to all the way at 12 to 1. Okay. And not only is the trade outcome better, but also the probability of it winning is higher because you've got 3 different time frames all stacked together. Okay, so that concludes the end of the video. Again, thank you so much for tuning in. This is the end of the market structure and the multi-time frame analysis section of the course. We're going to move on to the next section soon now. So this has been quite a big video. There's been loads of information in it. Do make sure that you rewatch it, make some notes, because this is really, really important. This forms the basis of all of my trading. So it's really, really important to make sure that you understand this one fully. Once again, if you haven't done so already, subscribe to my channel. Do head over to the Instagram, which is @StrongMoneyForex. Really appreciate the support. I'm giving all of my trading knowledge away completely for free. There's a Discord chat there, as we discussed as well, which has about 10, maybe even 8 spaces left in it now. It's completely free mentorship. There's no catches. All I ever ask from you guys is if you are enjoying this content, please make sure you like, share, and follow. Subscribe to my channel, follow my Instagram, and if you can pop that notification bell, you'll be notified when the next video and the next part of the course comes out. Thank you.